Your high-yield savings account sent you an email last Tuesday. Rates now 4.6%, up from 4.35%. Meanwhile, you've been watching mortgage rates for 3 months. They've barely budged. Same Fed, same rate hike, totally different timelines. Here's why banks move your money at 2 speeds. The Federal Reserve doesn't actually touch your accounts. It sets one rate, the federal funds rate, the interest banks charge each other for overnight loans. Think of it as the wholesale price of money. When that rate moves, it cascades through the financial system in stages, hitting different products at different speeds depending on how they're built. Some products are hardwired to that overnight rate. Others price off completely different benchmarks that move slower. Your wallet feels the Fed's decision eventually, but the path from Washington to your bank app has 4 distinct steps and 2 major bottlenecks. Step 1. The Fed announcement. The Federal Open Market Committee meets 8 times a year and votes on a target range for the federal funds rate. Let's say they raise it a quarter point from 5% to 5.25% to 5.2555%. This is policy, not a light switch. The Fed doesn't call your bank. It adjusts the rate it pays on reserves. Money banks park at the Fed overnight, so banks have no reason to lend to each other below that floor. By the next morning, the actual Fed funds rate, the average of all those interbank loans, settles into the new range. Wholesale price of money, updated. Step 2. The prime rate adjusts within 24 hours. Most big banks publish a prime rate, which is the Fed funds rate plus a markup, historically 3 percentage points. If Fed funds goes to 5.25%, prime goes to 8.25%, usually the same day or next day. This isn't a law, it's convention. Banks coordinate because prime is the base rate for a ton of consumer products. Credit cards, home equity lines of credit, and some adjustable rate loans are explicitly pegged to prime. Your credit card agreement probably says prime plus 12% or similar. When prime moves, your APR moves, typically within 1 or 2 billing cycles, 60 to 90 days max. This is the fast lane. Step 3. Savings and money market rates move at the bank's discretion, and they move fast when rates go up. High-yield savings accounts and CDs aren't contractually tied to any index. The bank can change the rate whenever it wants. When the Fed raises rates, banks can now earn more on reserves and short-term treasuries, so they choose to raise deposit rates to attract cash or stay competitive. Example math. If Fed funds is 5.25%, and a bank can earn 5.30% risk-free by parking reserves at the Fed, offering 4.6% on savings is suddenly profitable and appealing to depositors. You'll often see online banks update rates within days of a Fed move, sometimes same day. But here's the asymmetry. When the Fed cuts rates, savings rates drop just as fast. The speed is a feature of competition and profitability, not a rule. Traditional brick-and-mortar banks often lag or ignore rate hikes entirely if they don't need deposits. Step 4. Mortgage rates are on a different planet. A 30-year fixed mortgage rate is not based on the Fed funds rate. It's priced off the 10-year Treasury yield, which is set by bond market investors, not the Fed. When you lock a mortgage rate, the lender is thinking, I'm lending money for 30 years. What's the safe return I could get on a 10-year Treasury? And what premium do I need to cover default risk, prepayment risk, and profit? That premium is usually 1.5 to 3 percentage points above the 10-year yield. So if the 10-year Treasury yields 4.2%, mortgage rates might be 6.8%. The 10-year yield moves based on expectations of future Fed policy, inflation, and economic growth, not the overnight rate itself. This is why mortgage rates can fall even when the Fed is hiking, or stay flat when the Fed cuts. They're forward-looking. If investors think the Fed will cut rates in a year, the 10-year yield might drop today, pulling mortgage rates down before the Fed does anything. The lag isn't mechanical, it's psychological and market-driven. Let's trace one hypothetical rate hike. Fed raises the target range by 0.25% on a Wednesday. By Thursday morning, Fed funds effective rate is up. Prime rate is announced at 8.50%. Your credit card issuer sends a disclosure. APR goes from 19.99% to 20.24% starting next statement. Your online savings account emails you Friday, APY now 4.75%, effective immediately. Your money market fund updates the same day. Meanwhile, the 10-year Treasury yield dropped that week. Investors were spooked by weak jobs data and bet the Fed would reverse course in 6 months. Mortgage rates actually ticked down from 7.1% to 7.05%. All from the same Fed action, 4 totally different outcomes. Top misconceptions. 1. The Fed controls all interest rates. It controls one rate directly, Fed funds, and influences others through expectations and liquidity. 2. Rate hikes are good for savers, bad for borrowers, evenly. They're faster for savers on variable products, slower or invisible for fixed-rate borrowers. 3. My mortgage will drop when the Fed cuts. Only if the 10-year Treasury yield drops, which depends on what bond investors believe about inflation and growth 2 steps ahead. The Fed is one input, not the whole equation. Edge cases. Adjustable rate mortgages, ARMs, often reset annually based on an index like SOFR or the 1-year Treasury. Those do track closer to Fed moves but with a delay. Business loans and corporate credit are priced off SOFR, secured overnight financing rate, which moves almost in lockstep with Fed funds. If you're holding long-term bonds, rate hikes trash their value because newer bonds pay better yields. Your old bond is worth less. And if the Fed moves rates but banks are flooded with deposits, they might not raise savings rates at all. They don't need your money. Supply and demand still matter. Summary. The Fed sets the price banks pay to borrow money overnight. That rate becomes the prime rate within a day, which updates your credit card and HELOC in weeks. Savings rates move at each bank's discretion, fast up when the Fed hikes, fast down when it cuts. Mortgage rates price off the 10-year Treasury yield, which moves on expectations of future Fed policy, not the policy itself. One lever, 4 speeds, because the financial system has wholesale pricing at the core and retail pricing at the edges, and the edges don't all plug into the same socket. When the Fed announces a move, you're not waiting for one change. You're watching 4 different clocks.